maybe on YouTube or something. And I think we're there. So great. Well, I want to thank you guys for taking the time to do this again. I know we did this, it was back in like April or right before May, I believe. So just wanted to kind of get back with you guys. I know there's been, a couple months since we've talked, and, a lot probably has changed in that time. So I think I might just kind of maybe call you guys out, maybe one by one. And if you could just kind of do a brief introduction for anybody who might be watching this, to say who you work for, what you do. And then if you could just say what life has been like in your particular industry for the last couple months. So if we could start with Robin.
Sure. The date that you had chosen for the last call was the date of the real estate forecast.
Right.
I think April 21st or 27th. So May, June, 10 weeks. It's been about 10 weeks. And I was thinking about that the other day as, we were headed into, I guess you would say the fog, because we were really kind of struggling to try to figure out what the few months as they have unfolded would look like. And now looking back, I think the one thing we looked at in April, which was the first of the month, is that the rent collections were, for most owners, were pretty good for the month of April. Month of May was good. Month of June was good. Month of July is starting to show some cracks. And I think it could be the fact that, the best way to put it, just when we thought it was okay to get into the water, that we all of a sudden realized we all got to get back out. And I think that created a bit of a hiccup in that momentum that we were experiencing going into July. And now that the fact that we're taking a step back has caused a lot of owners, investors to recalibrate. So July rents were off, so we're approaching July with more of a trepidation. And August, obviously, now is looming even more ominous because of the end of the PPP, and we're beginning to see that this is going to be not as a smooth recovery as we all had hoped for. And up until, let's say, July 1st, up until the end of June, it was looking pretty good. Now it's created a new aspect in terms of sales. I just brought up on the screen and trying to get a kind of perspective looking back to where we are. Our market, which is basically the Madera, Fresno, and Tulare County markets, did about $370 million in 2017. In 2018, we did about $360 million. So, and those were both record-setting amounts. We closed 2019 with $283 million, which is about 30% off, 40% off from the previous years. So 2019 was down in terms of sales volume. Year to date, which is through now, we're at 117. So if we annualize that, you're at about a 228 number. So from a transactional perspective, deals were down before the virus. So looking ahead, we closed all the deals. If you remember, I was telling you about the deals that we processed, 5 or 6 deals. All of them held. All of them have closed or just about to close. We lost no deals or any kind of serious retrading in those transactions in the last few months. So what we've been seeing is basically 2 baskets of buyers since our last get-together. Basket number 1 were the exchange buyers, people in 1031 exchanges who got the reprieve right about the time that we had our meeting up until next week, July 15th. which extended the 45-day deadline and the 180-day. So for the last several weeks, there's been a lot of activity of people trying to finish that up. But what we're seeing is it's like a melting ice cube. As soon as we get past that, those exchange buyers are gone. And now we're left with people in the post-COVID environment about creating capital, becoming a buyer. And their pencils are a lot sharper than the exchange buyers. And so consequently, we're in that, as they call it, the price discovery phase. So the gap that exists between what sellers' expectations are and what the buyers think they're going to be able to get the deal. And the gap is as wide as it has been in a very long time. Consequently, the amount of deals were already declining, as I gave you the numbers, earlier on, are going to be substantially down going into the second half of the year. And it's going to take a while. Operationally, it's going to be a bit bumpy, not as bad as in other real estate sectors, but a bit bumpy in terms of the ability to collect. So the physical occupancy, while high, mid to upper 90s, the economic occupancy, which is the ability of those people who are in your apartments to pay rent, are going to be under pressure. And that's probably bouncing between 85 and 90%. So that means 5 to 10% of your residents, you're going to have to figure out what you're going to do. Lastly, since we talked, I said one of the wild cards that we had to worry about is the political climate. You remember I brought that up. There were a number of bills. Well, since then, there's been twice as many bills and extension of moratoriums that really has also colored the atmosphere. There's a recent bill, which is as crazy as it can get, AB 1709, which a number of senators are saying that any owner who chooses to sell a multifamily or a single family residence that's for rent, you have to give a nonprofit a first right of refusal to buy. And it's as wacky as it gets. So that one just is working its way through the assembly committees. And on top of that, remember, we have two other ballot issues, one of which is to just name Proposition 21, is basically it's basically Prop 10 2.0. It's another shot at trying to remove the Costa-Hawkins. Even though we already have rent control under AB 1482, what this new one will do is it'll control all of the vacancies, which is basically decontrolled today, even under 1482. What that means is that there will be the ability to restrict your ability to raise rents on the vacant units. And on top of that, for the other people who are on the panel, I'm sure you're very aware of the split roll. Leave it to you guys to talk about that. So it's still hopeful. I'm glad I'm not, pardon the other guys on the call, I'm not in your sectors. So as much as I can cry wolf, I see the challenges that you guys have, other than Ethan in industrial. But the retail guys and the office guys, your work is a lot more. Your work is cut out for you. So that's just my, quick and dirty on that.
Robin, can you say anything about maybe some of the new multifamily construction coming up? As far as the new units, maybe some that might be in the very initial development stage.
Sure. I think at the real estate forecast last year, I said there was about 2,500, which was like a 41 year historical high. We had never built as many units as what we had seen in the pipeline. What I meant by the 2,500 is either planned, under construction, or recently completed. There are a lot of apartments under construction and just recently come online. Obviously, the Row is now in lease up. Vandenberg has got his 250 plus unit over there at Copper and Friant. And then you've got a whole host of other properties being built around town. We're severely underbuilt. I think the challenge is going to be in the sub-market. So, I mean, if you look at the market as a whole, The amount of people that have moved in, I would say the amount of jobs you recreated, which obviously now that has worked in the opposite direction, but just the amount of population, we have not built enough apartments. Now we have a lot of apartments coming online. I'd say for the majority of the apartments, they should do fine. Where the difficulty, what you're going to see, is in a very tight submarket, which is the Woodward Park area where the Row is, Asimi's, Brookside, and a couple other ones that are right there. In that submarket, all coming on at the same time, it's gonna be difficult for the supply or the demand to take that supply down. It's going to be like a bulge. It's going to take a while to work down that inventory. I think in the end, we're going to see the most of them are going to get through it. The good news is, well, I'm not sure about good news, is one of the things that we were looking for at the real estate forecast in 19 is that we needed the rents to get up to about $1.40, $1.45. We just did a rent survey just this last month, about 35,000 units. And it was interesting to see, of course, a lot of it was pre-COVID data, is in the north part of town, we're easily over $1.30, $1.35 a foot, which is pretty surprising because it wasn't too long ago where I was saying that just getting over $1 was going to be where we were. Today, in the north half of the town, we're over $1.30, $1.35 a foot, on our way to $1.40. At $1.40, the new construction, notwithstanding certain properties like Tempranillo and the Row, $1.40, $1.45 a foot works pretty well. So I think from that standpoint, we should be able to take down the inventory, notwithstanding any hiccups that a particular submarket would be the Woodward Park. Also the Loop, there's 2 or 3 properties either just recently completed or are about to be planned and completed around the Bullard Loop. That's also a lot of units in a very tight area coming on about the same time. So for existing properties, occupancy's been good. We've got to work on the collections. New properties, especially if they're all chasing the high-end renter, there's a thin amount. But if I had to say this, the high-end renter are probably the ones who've been most immune to the virus, because they're working basically either can work from home or they're deemed essential workers. It's the blue collar, what we call workforce housing. Those are the properties that have really got hit hard with the virus. And they're the ones who, those kids at first drop have moved either back home to the parents or have doubled up because they're trying to reduce that load. So on the lower end, we've seen more difficulty. They're the ones who have a lot of PTE, or what we call promise to pays. So a lot of rent payment plans. But on the high end, on the properties that we're involved with, very little disruption in terms of collection, occupancy. It's actually been, one owner of a large property said he was surprised on just the amount of garbage his trash cans. He's actually had to call for more pickups because of the amount of people who are working from home. So.
All right, thank you, Robin. Ethan, you mind telling us what's what?
Sure. So my focus is on industrial, and we're pretty fortunate that the industrial market has held up pretty well. I think it's a bit of a bifurcation between local businesses that, depending on the industry they serve, things could be a bit slower. And then you have national companies that were already adjusting to using warehouses as their fulfillment or essentially their retail arm. Since we talked, I think that it's become pretty apparent that industrial real estate is going to be a very much preferred asset class moving forward. Our market doesn't typically have a lot of buildings that are available to institutional or public ownership for industrial. That might change. I'm aware of a couple of national developers that have looked in this market. They have customers, clients, tenants of theirs that are actively and trying to quickly move up projects that perhaps were in the pipeline, but with the expectation that a pretty significant percentage of sales are going to remain online. And you've seen Target and Walmart sort of separate, and Best Buy to a certain degree, from a lot of the other retailers, and obviously Amazon. But all the calls I've been on since we talked last in April, the large institutional owners are collecting 97, 98% of their rent. Any relief they're giving is typically to small tenants who, have a story, but they're making those relief requests very much subject to sort of almost forensic accounting. Going to your landlord and saying, hey, I need a couple months free, isn't going to result in the landlord typically saying, sure, no problem. It's likely to be a relatively deep dive into why it's not successful. So we haven't seen some of those things that were maybe predicted back in April come to fruition in industrial. Probably the biggest challenge we've got locally is entitlement risk is creeped into the industrial market, meaning there are forces at work that aren't quite as friendly to industrial development as they have been in the past at many levels within this area. And so projects probably can't happen as quickly as they might have a year ago. The city of Fresno is struggling to process permits and improvement plans right now. They're still working remotely. You can't go down to the city and pull a permit or meet with anybody at this point. So timelines are lagging a little bit. Whether that really ultimately creates a backlog or projects get shelved, I doubt it, but it just is going to mean the timelines are longer. I've been on a couple calls in the last week and was speaking with someone this morning. And this does speak to kind of, Robin, you're talking about where investments are. I mean, we've not really been an industrial investment market, but just to kind of give the perspective on where numbers are, in the general consensus is that industrial rents nationally are actually higher than they were in March, and are not going backwards. So the demand far outstrips the supply right now, and certainly in dense markets, which Fresno wouldn't really be one of those at this point, there's far, far more demand than there is supply of infill buildings. The drive to get the customer their package the same day, which is, Amazon kind of got interrupted in that process for a few months, but you've ordered from them recently, that the shipping timelines have compressed again. Other companies are going to try to do that. And the question though is, how much of that can they achieve using third parties? Because there's only a couple, there's Amazon and Target and Home Depot and Walmart are about the only ones that can run their own delivery networks. Everyone else is going to have to use someone else. So a place like Fresno, which doesn't have the density of people that a Bay Area or the LA Basin does, we might not see quite as much same day delivery as you would if you were in those other markets. It might still be next day, which, for most things is still pretty darn good. The sentiment, at least within the industrial market locally, is pretty positive, but deal velocity has definitely slowed. The local businesses, which are much, much more susceptible to, the emotional roller coaster that everybody's been on for the last couple of months, and the uncertainty Robin mentioned about the political environment, those folks are much more, hey, I'll take a pause at this point and see how things go, versus the national companies that, they're pretty unemotional about things. These are decisions that are made with respect to an entire country, and the need to take market share at a time when they see blood in the water, frankly, with a lot of their competitors. I mean, if you believe that the American consumer will not spend, then, maybe you're okay with, half a dozen retailers going out of business. But I think most of the clients I'm working with feel like that revenue is going to go somewhere. And there'll be new companies that will come up to take that revenue. And then, the big are just going to continue to get bigger. So just to put in perspective, Matt and Robin, you'll appreciate this. I heard on a call this week that there's a couple of Amazon delivery stations that are being finished up on the West Coast. They're expecting to trade at sub 4 caps. And then in the Northeast corridor, some are trading in the low to mid 3s. And then last week, KKR, which is obviously big private equity and advisor and money, they bought 2 large Amazon projects in secondary markets at sub 5 caps. So those are all sort of in the Southeast, but interesting that kind of trade is occurring, which just speaks to the belief that industrial is a relatively safe harbor and probably an opportunity to, count on receiving that income for the foreseeable future.
Well, thank you, Ethan. Brandon, you mind sharing?
Yeah, give me a second. I'll unmute myself here. So wasn't interrupting anybody. But my name is Brandon Lamonica. I'm with Fortune Associates Commercial Real Estate Firm, and I specialize mostly in office, leasing, sales, and development. And since our last time on this call, I think things are still a little bit murky as far as the future for most of the tenants that we're talking to and landlords. I think the existence of the PPP loans has definitely assisted a lot of companies in being able to stay current on rent. As Robin kind of talked to about it, we haven't seen much of a dip off for non-payment of rent or payment plans being put in place at this point. We have had certain tenants that are non-essential that ask for some type of relief. I would tell you the majority of our landlords are working through those things on a case-by-case basis. So, and much to Ethan's point, asking for financials and definitely trying to dip into how hard a particular tenant's been hit, depending on their sector and kind of where their focus is. Fortunately for our market, most office uses are considered essential. So you haven't seen a shutdown in a lot of areas, unfortunately, that Mike's dealing with in the retail sector, as it yo-yos back and forth. But I think the thing that we're looking at right now is, when will the deaths really settle? And I think the thing that I've been kind of talking about, we talk about the political climate, and I also think there's a big thing that will be coming down the pipeline next week too, is when they start talking about voting on what's going to happen with the schools this year. Obviously, employers and office buildings, if they have employees that have children that can't go back to school and they don't have any place to take them, then we're going to continue to see a lot of people working remote. And how that will affect the market is unseen at this point. But even in just some general conversations, you are finding companies that have in the last 10 weeks since we talked, investing a lot of money into infrastructure or IT services, the cloud-based services that will allow them to allow their employees to work more easily from home, and kind of survive that if that's what this ends up looking like. I would say deal activity is definitely low. It's been more active in the smaller size range, and that's normally the case in any down cycle. smaller tenants, moving around to try to save money or do shorter term deals. Larger existing tenants have been signing short-term renewals just to kind of wait out and see what's going on. And in certain cases, in certain areas, we've seen rents dip a little bit. I think what you'll find is interest rates are still low. There's still a lot of people that are interested in maybe taking their money and trying to invest into an office building and owner occupy it. But the product and the amount of product on the market for sale is very limited. And I know that's the same with the industrial market as well. So from that standpoint, values are still holding very strong because there's still a need a large group or pool of buyers that would be willing to buy stuff if it was available. But right now, we haven't seen a big dip in rents. The thing that really affects our market probably more than, the retail or the industrial sector is how we're set up is how improvements are done for new clients and new businesses going into a particular project. And just as of the first of this year, the state of California revamped new construction codes for Title 24, which have increased our costs on electrical and mechanical. We just got some bids back last week that came in higher than we expected. And a lot of it was due to those Title 24 changes. So the cost of tenant improvements going up to modify buildings is probably our biggest stretch for deals right now. If you do have a tenant that's willing to lease a space and sign a long-term lease, then the biggest issue comes back to who pays for the improvements or how those costs either the pass through to the tenant or if a landlord's willing to absorb those costs in order to get a tenant. And I think that's where we're in a similar place as Robin, where there's a large gap there because obviously tenants feel like that's a landlord responsibility, and landlords are in a particular position where there's a reasonable amount for improvements, and then there's some portion that it's just specific to a tenant's use. So that's probably where the largest gap is in our industry right now. I wouldn't say it's so much on rents or values. It's more just on how we structure deals and how we can finalize deals when it comes to doing certain improvements. So, but like I said, we haven't seen a lot of major moves going on. There are some larger groups that are out in the marketplace looking for space, but not a lot of deals being inked at this particular juncture. And I think a lot of that'll continue to be kind of as people kind of kick the tires on the market to see what's out there and see if there's a reason to move. And if not, maybe just signing short-term leases. And I think that'll continue for the foreseeable future, probably through the end of the year. And then, when you get into the political climate, I think, we're not exactly sure how that's going to play out yet. And, but if people can extend leases, into the late part of this year, early part of next year and see what happens there, they may have some input on how it might affect their individual business. But right now we're still in the same position, trying to assist both landlords and tenants and trying to help everybody through this, this process and this time period to try to be successful and still make money and still stay afloat until things can get back on track.
People have kind of painted the whole work from home thing as almost like an existential threat to the office industry. You think that's overblown?
Not necessarily. I mean, again, there's a lot of rumor mills, but some of the national groups that have been talking said that, the office market over the next 2 years could be reduced by almost 1 billion square feet nationally. With certain companies going to work more remote. I think you will see it much on a larger corporate scale. Now in Fresno, I wouldn't say we're more of a mom and pop, sole proprietorship, partnership, LLC, small company type environment. So we do have a lot of national tenants, but with that being said, we don't have a host of them and we don't have a lot of large ones. Most of our largest tenants are state, IRS, federal, Caltrans, mostly medical. So the Kaisers of the world, community medical centers, have large spaces. We have a few very large insurance companies here that have a presence. But overall, our average size tenant in the Fresno Clovis market is only 2,800 square feet. So, regardless of those larger tenants and what they're willing to do. Now, I think the one thing when you talk about that is on a state level, because they're probably our largest leaser of commercial office space in our area, is if those employees, much like Ethan mentioned, that, the city of Fresno right now is shut down. So, getting plans through to do tenant improvements or to get projects out of the ground or do things like that, with those people working from home, is that the new future? And, could you see the state start cutting, the use of having physical office space for a lot of the different divisions that they have? So if that happens, then there'll be a lot of space on the market, and that could significantly affect the market if a user as large as the state of California decides to cut back on having physical office space and put people from home, working from home. But that's none of that's, we're all waiting for that. So we'll see. It could be a trend that's short term, it could be a trend that's long term, but only time will tell at this point.
If I could just quickly interject on that's working from home. In talking to a lot of the owners who own in the urban markets, the San Francisco, San Jose, Los Angeles, the work from home problem is amplified because a lot of those people use public transportation, be it BART in the Bay Area or Caltrans going up the peninsula, or they're also afraid of going into elevators. So it's that commute part that's caused a lot of anxiety. And so what they've been finding is a lot of people have, and I say in a past tense, have already moved out of the San Francisco area in downtown LA and have moved out to the suburbs, either with family, friends, or went out and rented an apartment and just break their lease. And they're renting and they're working from home, because their owners are allowing them to do that. So in that first outer circle of a lot of these highly urbanized areas, there's been a huge exodus of people who have gone and moved because they just don't want to be in that environment. And if their employer says, go ahead and do it, it has happened in droves. And so many of the owners in the outlying areas, East Bay, Tracy, Manteca, Stockton, Sacramento, have seen a huge amount of people who have moved out of the cities and are taking advantage of that working from home. Here it's a little different because you're only talking a 5-10 minute commute to the office. And then you could probably talk about some people come in afternoon, other people come in, but it's that commute that, into a highly urban, dense environment, especially if all the restaurants, stores, and museums are closed in the city. What's the point?
Well, I would tell you the thing that we've kind of seen with talking with business owners and stuff is that even though a portion of their employees are working from home, they're still utilizing the square footage that they have to be COVID compliant. When talking specifically of COVID, I know a lot of the furniture companies and design companies here have been working to expand cubicle systems, put up the plastic temporary height increases on the cubes so that you have distance control, only using every other cube. Same when you walk into certain office buildings and you walk into a waiting room that, a handful of the chairs are roped off. So, they're seeing less clients. I think that's another thing on the medical side we talked about last time was with not as many patients being able to move through going to telemedicine. And, will that be a thing that will continue, especially with patients that are more, have minor health, procedures. If you're going to see your general physician or pediatric doctor, and it's just a checkup. If nothing's wrong, why expose yourself to going into a medical office where there could be potentially sick people? But the other thing that we're seeing that's been a bit of an issue is that, there have been a handful of cases where companies have had an employee test positive and they've had contact in the office and then having to shut an office down for 2 weeks or 3 weeks until everyone's been tested. Wasn't very prevalent when we first had our call. And obviously with the spike in COVID, those stories are becoming a little more real, I would say, and how employers are having to, combat that, which is having people work from home. And, again, and until things calm down a little bit, I think employers are, for the most part, for everybody that I've worked with and have talked to, are being very diligent about making sure that they're providing a safe work environment, whether those employees are coming in or if they have the ability to work from home and helping them get set up, be able to work from home efficiently. So, I'm sorry. I heard an anecdote from somebody in the Bay Area, Robin and Brandon, like on the existential question. This person who focuses on downtown San Francisco office, and he was commenting on the
type of employees that are typically in those buildings, pretty young, single, if they're not making $200,000 a year, they probably have 2 roommates in an apartment. But what he mentioned when someone said on a call, hey, look, it's not good to be an office broker in downtown San Francisco right now. He said, well, just remember though, that these kids are all getting fed at work. They have all kinds of perks. Their laundry is taken care of for them right now. Now they're at home 24/7 with 2 roommates on the same Wi-Fi. They're trying to steal internet connectivity from the neighbor. And while they didn't really care that a burrito cost $15 before, because they only got it at midnight, and now they're having to pay for 3 meals a day, and it's real that the cost of living in San Francisco is really high, they want to go back to the office. They want to save $500 a week on food. So that was sort of his response to the existential question. And then he said, the other thing is half these kids meet their spouses at the office.
Yeah.
Unless you want to marry your roommate, it's pretty tough to find your significant other if you're working from home every day.
Well, I can tell you this. I'm sitting in a bedroom right now because I can't be found in my office, and not for those reasons, but for having kids at home. And I think that's part of the challenge of working at home with things like that. And, that's kind of brought me back to the comment I made earlier about whether school will be in session or not this year, and how effectively you can work from home if you have a family with young children or even older children for that matter. It's definitely a much different scenario because a lot of people are used to telecommuting in the Bay Area, where they may even come to the office only maybe once or twice a week, or maybe once or twice a month. But I think it would be a big change for us here. But I think that moving into Mike talking about the retail sector, if you're working from home, you're not going out to lunch, you're not going to grab a drink after work. There's a lot of things that exponentially change by working from home. Some of the strongest sectors we've seen, obviously the recreational sector has been huge, and I'm sure that's on the industrial side too. But the fruit and produce brokers, vegetable brokers, guys on the ag side who are moving product, because more people are working from home, having to cook 3 meals a day from home. All those things are transpiring, and there are sectors that are doing really, really well and outperforming themselves. But as a whole, I think it's just the uncertainty, and if we keep getting funded by the federal government, I don't know how long it will be till we really know where the bottom is.
Thanks, Brandon. So I hoping Mike has some good news to share from his world.
My name is Michael Arfsten. I'm at Retail California. Focus is all retail, which has been a challenge and rough lately. As far as it goes from the landlords, since April, they were bombarded with rent reduction requests. The ones that I've spoke to this month, most of them got their rent, or at least they're getting the majority of the rent is coming in. A lot of them had to work out, we'll give you 2 or 3 months deferred rent, extend their term a little bit. But by and large, the tenants that are still open are paying rent. The percent on that is probably, in April it was probably, 40 to 60% were paying rent. I've heard closer now to, 60 to 80% of them are paying rent, which is good. The problem being that now that we're, 4 months into it, those rent reduction requests are now fading away. So it's going to be kind of interesting to see if these tenants can pay rent going forward, and how that's affected. 2019 wasn't a great year for retail either. So we're kind of, 2019, I think there was just under 10,000 retail shops across the country closed. Projections I'm reading as recent as today, that number could hit 25,000 for 2020. So that's a big jump. And it seems like every day when I turn my computer on, there's 1 or 2 new companies that are filing bankruptcy. So it's a real problem the landlords are dealing with. I had a landlord call me this week, They have GNC in 2 of their centers. GNC filed bankruptcy. I think today, so La Table filed bankruptcy. So it's every day it seems 1 or 2 tenants are trying to restructure. Primarily they're not open, they're not creating sales. They're trying to shed, I think, their underperforming stores and keep the ones that are making the money going strong. Restaurants have been particularly hit hard. I've talked to a lot of restaurant tenants in the last month or so, and they're just trying to survive right now. And I think the start and stop affects them a lot too. They're trying to figure it all out. This week alone, I've seen a lot of these restaurants, even Denny's, I was driving by today, they're setting up patios outside in hopes to try to attract some customers. Well, in Fresno, and this weekend when it's 106, that's not going to go over really well. So there's a lot of challenges they have to deal with there too. Who wants to go sit out and have breakfast or dinner when it's 105 degrees? So it's been real tough on them. We're already starting to see some restaurants close. The good side of the coin is when a restaurant closes, there's always 1 or 2 that'll take a look at it, just because of the cost savings that go with that. I have one on West Shaw. I have 3 offers on it. So that's not uncommon if you have a restaurant space. It's a lot more uncommon if you just get strictly a retail space back. They're not lining up to lease those spaces. The A and B retail, the better centers, they're still getting activity. We're still getting calls. When you start going down to the C and the D retail sites, those can sit for quite a while. I'm telling a lot of my landlords, they're out calling me, asking what they should do when their tenants want rent reductions, or they're threatening to say their lease is coming up and they're coming back now at 60 to 70% of the rent they were paying. I'm suggesting just try to make the deal. You don't need more vacancies than you already have, unless you have a center that's 100% full and you have a problem tenant. Then go ahead, let's try to replace him. But in retail right now, it's trying to hang on to your tenants is real important. As far as sales go, the multi-tenant, there's not much out there, and what I'm hearing too is that it's pretty hard to get those financed right now, unless it is a single tenant and a national credit tenant. You're gonna have a real tough time moving that property. The other thing I would mention too is we're seeing these tenants are trying to adapt. They're changing what they're doing, especially the restaurants. They're doing more DoorDash and things like that. Talked to a restaurant today, and he's like, if I didn't have that, I'd be out of business. That's what's kind of saving me right now, is that 40 to 50% I'm getting is keeping me going as we move forward. Looking forward, I think landlords don't know what's going to happen. They're real nervous about what the next 6 months to 12 months is going to hold. And it's going to be interesting to see how we move forward. I mean, movie theaters are still not open. I think some of them are planning to open as early as tomorrow. But I talked to a landlord today who has a theater as his anchor, and he's not sure if that's going to happen. He says it's so fluid. It's changing hour by hour what these tenants are doing. So it's making it really hard for the landlords to adapt and figure out how to move forward and promote their shopping center. So it's going to be a tough, I think, 6, 12, 18 months in the retail sector for sure.
Are you guys facing any of those kind of wacky stuff coming out of Sacramento as far as landlords kind of having to bend over backwards?
We're starting to see them, and even the offers we're getting in are, the tenants we've been bringing up, hey, this is a COVID offer. We're coming in, we know it's 40% below market, but this is what we think we can get right now. So they're taking advantage of it. Yeah. For sure.
Thanks, Michael. So Sullivan, I think last time when we did this call, we didn't get a perspective from farmland. So just wondering, what you kind of saw early on and what you're seeing today.
Sure. So I'm, as I mentioned, I'm driving right now, but I'll find a spot to pull over and then I'll show my shiny face. But anyways, the ag market has been very volatile with amongst the other specialty sectors that you were all discussing. Early on, I joked because Fresno is typically 3 or 4 weeks behind the Bay Area and Southern California when it came to the pandemic. So everything that was hitting over there early on, we didn't think it was going to hit us, but then it did. Well, jokingly, the farmers are probably 2 or 3 weeks even more delayed than everyone else. So they thought that they weren't going to be affected. But it seems to be a bit of a perfect storm on the ag side because we had a lot of issues with, of course, slaughterhouses and packing sheds having to really start monitoring their employees. And sometimes there were some positive cases that spread throughout some of these large packing sheds, and that had a major effect. But on the fresh food side, so tree fruit, oranges, grapes, things like that, they had an initial push that increased demand. Right, everyone was going to grocery stores and purchasing their favorite produce because they thought they were going to live off canned goods for the next 6 months. So they used up that, but then after a while, that stopped and the stocks were reshelved, and product was back on the market. Here I am. So the issue is, though, when the U.S. economy is going through a sliding market, agriculture can usually rely on exports to keep us afloat. But when all the other nations are going through the same issues that we are, we can't export as much as we normally would. So that brings up the next issue, which is the ports in these other nations. A lot of the ports have shut down due to the COVID, and we can't get product overseas. And if it is shipped, it's sitting on the water, and that's a whole nother issue. And even for perishable products, but non-perishables also, like nuts, there's shipping containers, thousands sitting in the ports on boats, not being unloaded because the ports are shut down. So buyers aren't really aggressive in buying our products from other nations. Now, the second issue we're up against on the agriculture market right now is our total almond production is going to be 18% higher than it was last year. Both objective and subjective numbers have came back in the last week, showing that it'll be about 3 billion pounds, which is a record-breaking crop for almonds. And everyone up and down the state, because we had such a mild winter, have said that their trees look heavy. And I'm in Merced right now, and I can see an orchard right now that has limbs that are breaking because it's got too many nuts on the trees, which normally would be a good thing, but it has really put downward pressure on the almond prices. So just as a perspective, last year, on average, almonds were selling around $2.25 per pound. And right now, they can't sell them because no one's buying, but the prices are close to $1.50 on average. So that's close to 40%. And some people are projecting that that's going to slide even more. So on the nut side of things, pistachios are showing that they're going to have a record crop, but they think that demand will keep up with supply, which is a good thing. But there's pressure there also, and I think they're going to be a little lower in pricing as well. So over the years, we have shown that land values track almond and commodity prices very parallel. So right now, we're anticipating, given history will prove it, that when the almond prices drop, and they don't show that it's just a quick V drop, but it's going to bounce along the bottom for a year or two, that land values will do the same. But if you bring in the additional variable that agriculture is up against, which is water, there's a lot more to play than just that. I think much like Robin's comment about the 1031 buyers, I call them transitional buyers, but they're farmers that want to sell out of their lesser water areas in weaker water areas and purchase ground in stronger districts. So that would be like Westlands, for example. Westlands Water District right now is sitting on $800 per acre foot water. It takes 3 to 4 acre feet to grow almonds. So right there is $2,000 to $3,000 worth of water to farm your trees this year. So that is a very big number. And add on top of it, you're not going to get the return for your almonds that you're used to receiving. So at $1.50 almonds and $800 per acre foot water, it doesn't work. So guys are selling 500-600 acres or more out in these lesser water areas and willing to buy 100 acres or 160 acres in a good water district. And they're somewhat desperate. But with these almond prices, I don't think buyers, even in the best water areas, are going to get too aggressive. There is a number where it just doesn't pencil, where open land value to purchase in FID at $30,000, $35,000 an acre, and then have to add money to improve it to pistachios or almonds or walnuts or something like that, is now you're at $40,000 an acre by year 4. And it takes you a very long time to get a return on that investment. So right now, we're also just waiting to see where the market's going to start to settle. I think consistent with what's been going on in the past is good water areas will maintain their value right now, if not slide slightly. But we're still waiting for data to prove that. But in lesser water areas, I think we're just going to continue to see values start to go down, and it's going to be a tough year. And I've been at Pearson for 4 years now, and we've seen always every year see farmers get in over their heads. But guys that were projecting their average price per pound at $2.50 for almonds, and they're over leveraged, are going to be suffering, and I'm sure they're sweating right now. So not good to see from our perspective, but I think this would speak equal to all of us that are on this call. Now is when people need their brokers more than ever, because we're studying the market every day and we're trying to find solutions for everyone, and now is where we really put value on our clients. So, and one thing I want to add, and this is on a higher level point to everyone and any viewers that are watching this, given the pandemic that's going on right now, I think a lot of people, my wife's in the healthcare system as well, and a lot of people are so scared to go and get routine checkups or get surgeries that they have known that they need and have been delaying things. And my advice to you and your all your relatives and friends is don't wait. Be a squeaky wheel and get in and make sure you put your body first. If you're healthy or not, don't let the corona put fear in you to not go take care of yourself. I've had a handful of friends and affiliates that have delayed that due to COVID, and it's not been a good result. So it's been a lot worse. So that's my piece of advice for everyone today is if you need something done on the medical side, is be proactive about it and don't let the corona hinder you from doing that.
Thank you, Sullivan. So Matt, can we talk about money?
Yeah, Matt Renney, California Realty Capital, do commercial real estate finance. I think when we had the last call, the market at that point, there was a lot more questions than answers, and we weren't sure where we were going. I think I had mentioned that I had a lot of transactions that were in process. The majority of those that were in process got done. There were several transactions, though, sale transactions that were in the early stages that folks either canceled because of the uncertainty in the market, or instead of buying two assets on an exchange, bought one all cash. So there was a few folks that, kind of pulled their horns in and to see kind of where we were headed. So overall, I would say over the last 8 to 10 weeks, it's been choppy. The last 2 to 3 weeks, we've seen a little life in the market and folks looking to maybe do some refinancing, once they've seen how their specific properties were going to perform. We've seen some folks coming back out looking for exchange properties and maybe some new debt. So there's been an uptick, but I'm concerned that, with the uptick in COVID cases, that might not, whatever momentum we had, we might not carry forward for, in the near term. From an asset class perspective, I think everyone kind of shared on the call. If I was to rate what lenders like and what they're concerned about, I would say that multifamily and industrial right now are where most people have the most interest to lend. Office is under a lot of scrutiny, and the retail lending is sparse. I mean, unless it's a bulletproof single triple net tenant, that has a national, presence, you're going to have some difficulty right now lending on retail. From the lender group perspective, I touched on 4 last time. The CMBS market, which is commercial mortgage-backed security market, most of those lenders were out of the market. I think the last time we were on the call, and I think today most of them are back in, and a lot of that is because the Fed purchased most of their existing products. So thank you to the government, they are back in, but they're being much more conservative. I mean, I think most deals are at the end of the day around 70% LTV, and pricing in that specific product is like 4% range, maybe a little better. It just depends on where it's located, if it's a tertiary market or a major market. The life insurance companies, they're still seeking new loan opportunities. As a whole, they're in that 60% LTV range right now. And I would say rate-wise, they're 3.5% to 4%. There are some stuff that you're hearing at 3% and even a little under in major markets. But for our market, I think you're looking at around a 3.5% to 4% coupon right now. They're not quoting spreads. They're just giving you a coupon and saying, if you'd like to do a deal, here's your rate today. Whereas, a couple months ago, we were getting a 10-year treasury plus a spread. So they're being very specific in how they're looking at deals. Again, they are probably generally a pass on retail right now. Office is, it depends on what kind of asset it is. And then multifamily and industrial are definitely something they're seeking out. The agencies, which is multifamily related, which is Fannie, Freddie, FHA, and HUD. I mean, they haven't stopped. They've been lending since, 3 months ago and today. They were adding some reserves to sort of shore up any risk in the market. They call it a COVID reserve, which was like a P&I reserve for 9 months, maybe 12 months, depending on the leverage. But they're still actively lending. And I would say their rates today are 3.25% to 3.75%. You can actually get your leverage up to 75, 80%, depending on where your cap rate is on a purchase right now. So again, they're out there and they're willing to lend, probably just a few more reserves attached to a deal at this point. Banks are still active. They're doing recourse loans, and they're making sure that the tenants are in place or paying rent or strong, and that the owners have a balance sheet that can back it up and carry it. Overall, it's been a little more positive, I'd say, the last 2 to 3 weeks. I've actually started some new transactions, some purchase transactions. So I'm positive, but also concerned that, with the uptick in COVID cases, maybe this is going to be a false start, but positive nonetheless.
Great, thanks, Matt. So it looks like we're almost up on our hour. I want to see if maybe Edward had a follow-up question you want to throw in after hearing all that. You there, Edward?
Yeah, I'm here. No, I think that answers pretty much everything. I don't have any questions that'll take less than 10 minutes. So
All right.
Gabriel,
Yes.
I wanted to just sort of like bring up, we talked about this last time, sort of the idea of this, what's going to happen to the real estate values. You know, everybody keeps talking about, you know, it's going to go down, it's going to go down. And we all sort of said, there's no data to support that at this point. You know, transactions, which they're slow, you know, there's still a lagging indicator as to kind of where things really are. But at least generally across the categories, I don't think that we're able to point to much data and tell an owner, yeah, you should take that offer that's 70% of what someone might have offered you 6 months ago, and point to data and say, here, let me show you why. It's much more of an individualized decision still. Now, my sector, industrial, we just haven't really experienced that because the product supply is so limited, and there's still more demand to buy by owner users than there is supply. But those people that are asking about buying are coming to the conclusion, well, it should be less. If you told me this building was $1 million in February, and I was asked that yesterday, well, what would it have been worth in February? I said, probably the same thing it's worth today, you know, and well, that doesn't make sense to a lot of people. It intuitively doesn't make sense. And so we're in that place where we sort of were at the beginning of the financial crisis, where you just have this gap between, you know, what a seller says, what a buyer says, and what Sullivan was mentioning. You know, we as brokers are trying to sort of divine kind of like how to make these two groups come together when there's just not really data to support either side. Other than, at least in the case of industrial, I can point out rates are not actually going down, they're going up in most categories. When you tell that to somebody, they think that you have, one, they look at you like you had a third eye, and two, they think that you're probably medicated or not medicated. So it's definitely a challenge to talk to people who look at the headlines and see a really, really unknown and scary situation, and then say, oh yeah, by the way, the value hasn't really gone down. So those are going to be really tough conversations, and it's hard to put those deals together.
Can I ask a question really quickly?
Yeah.
What have there been enough transactions to establish comparables, or?
No,
No.
Yeah.
I was going to say, I'd jump in there with Ethan. I think we're dealing with the same thing on the office side, is that, you know, you have this expectation level that whether it be from an investor or from a tenant who's looking for new space, that there should be some reduction in rent, or, you know, the market slipped. But with the limited amount of transactions that we're having, and we're all probably seeing the same thing, that you just can't delineate that there's the rents have gone down or values have gone down on sales. Inventory is still low on both, I know, the office and the industrial side. So that's going to continue to be that way. And the cost of new construction is off the charts. So that also maintains existing values of buildings. But until we get to a point where we really see enough transactions in our particular sectors, it's really hard to go to either a landlord or a tenant and honestly say, this is where the market is trending. And like I said, on our end, we have another factor that some of the office warehouse guys and industrial guys don't deal with, is the large amount of tenant improvements. So that can swing a deal one way or another very quickly. Again, I'm seeing the same thing that Ethan's seeing, and it's definitely a challenge that we're facing every day as brokers.
Yeah, if I can add a real quick comment about that from the multifamily side, is in the last call we had, I mentioned that the amount of inventory for sale was very low. And so going into the virus, inventory was down. So while I mentioned that the amount of buyers are drying up, we didn't have a lot of inventory for sale, and that continues to this day. So while there's a gap, I think the tendency, as long as you keep the rates down, prices will hold quite fine.
I think rates are staying down.
That's all we want to hear, because that's going to be the lifeblood of everybody.
Amen.
Good job, Matt. Good job.
Well, I just want to thank Ethan for once again helping set this up. I want to thank you guys for taking the time to do it. And I think a lot of our readers are going to be really interested in what you have to say. And I hope we can do it again soon.
Love to.
Thanks, Gabriel.
Thanks,
Appreciate
guys.
you.
Thanks, guys.
Have a great
Bye,
afternoon.
guys.
All right.
Thanks and take care.
Thanks, guys. Bye-bye.